tensions are adding layers of ambivalence to the overall global outlook. Notwithstanding a highly transmissible third wave driven by the Omicron variant of COVID-19, India is charting a different course of recovery from the rest of the world. India is poised to grow at the fastest pace year on year among the major economies, according to the projections made by the International Monetary Fund, that is the IMF. This recovery is supported by large-scale vaccination and sustained fiscal and monetary support. Once again, frontline warriors have admirably risen to the call of duty. As we gain valuable experience from repeated waves of the pandemic, our response and our overall responses are also becoming nuanced and calibrated. Protecting life is paramount, and protecting livelihood is rising in the hierarchy of priorities. The focus is on securing the economic and financial conditions of the vulnerable, the wage earners, and all those who have been affected the most. Accordingly, the emphasis is shifting to targeted containment strategies and a push towards universal vaccination and booster doses. This approach is being complemented by increased adoption of technology in our workplaces and in our day-to-day lives. The effort is to limit the extent of disruptions to the economic activity. In this overall environment and this background, the Monetary Policy Committee, that is the MPC, met on 8th, 9th and 10th February 2022, and based on an assessment of the current macroeconomic situation and outlook, it voted unanimously to keep the policy repo rate unchanged at 4%. The MPC also decided by a majority of 5-1 to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy, while ensuring that inflation remains within the target going forward. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. The reverse repo rate also remains unchanged at 3.35%. The MPC flagged the potential downside risks to economic activity from the highly contagious Omicron variant. Reassuringly, the symptoms have remained relatively mild, and the pace of infections is moderating as quickly as it surged. There is, however, some loss of momentum in economic activity as reflected in high-frequency indicators such as purchasing managers' indices for both manufacturing and services, finished steel consumption, and sales of tractors, two-wheelers, and passenger vehicles. The demand for contact-intensive services is still muted. Going forward, positive impulses for quickening the pace of recovery emanate from buoyant Rabi prospects, robust export demand, accommodative monetary and liquidity conditions, improving credit offtake, and the continued push on capital expenditure and infrastructure in the Union Budget 22-23. The MPC also noted that consumer price inflation has edged higher since the last meeting, but largely along the anticipated lines. The increase in inflation in December was entirely due to unfavorable base effects despite month-on-month decline in prices. Large buffer stocks of cereals and effective supply-side measures augur well for food inflation. Core inflation remains elevated, but demand pull pressures are still muted. The renewed surge in international crude oil prices, however, needs to be closely monitored. On balance, headline inflation is expected to peak in Q4 21-22, that is in the current quarter, within the tolerance band, and then moderate closer to the target in the second half of 22-23, providing room for monetary policy to remain accommodative. At the same time, output is just barely above its pre-pandemic level, while private consumption is still lagging. Global headwinds are accentuating. Overall, taking into consideration the outlook for inflation and growth, in particular the comfort provided by the improving inflation outlook, the uncertainties related to Omicron and global spillovers, the MPC was of the view that continued policy support is warranted for a durable and broad-based recovery. I think this particular sentence is very important, so let me just read it once again for better clarity. Overall, taking into consideration the outlook for inflation and growth, in particular the comfort provided by improving inflation outlook, the uncertainties related to Omicron and global spillovers, the MPC was of the view that continued policy support is warranted for a durable and broad-based recovery. I would now like to focus on the domestic growth scenario. In India, real GDP growth at 9.2% for 21-22 takes it modestly above the level of GDP in 2019-20. Private consumption, the mainstay of domestic demand, continues to trail its pre-pandemic level. The persistent increase in international commodity prices, surge in volatility of global financial markets, and global supply bottlenecks can exacerbate risks to this outlook. Going forward, government's thrust on capital expenditure and exports are expected to enhance productive capacity and strengthen aggregate demand. This would also crowd in private investment. The conducive financial conditions engendered by the RBI's policy actions will provide impetus to investment activity. The surveys done by the Reserve Bank reveal that capacity utilization is rising, and the outlook on business and consumer confidence remain in optimistic territory, which should support investment as well as consumption demand. The prospects for agriculture have brightened on good progress of winter crop sowing. Overall, there is some loss of momentum of near-term growth while global factors are turning adverse. Looking ahead, domestic growth drivers are gradually improving. Considering all these factors, real GDP growth is projected at 7.8%. I repeat, 7.8% for 22-23, with Q1 22-23 at 17.2%, Q2 at 7%, Q3 at 4.3%, and Q4 at 4.5%. I would now like to turn to inflation. The CPI inflation trajectory has moved in close alignment with our projections. In particular, the softening of food prices is providing welcome relief. The improving prospects for food grains production and the expected easing of vegetable prices on fresh winter crop arrivals are adding further optimism. Moreover, the softening of pulses and edible oil prices is likely to continue in response to strong supply side interventions by the government and increase in domestic production. The hardening of crude oil prices, however, presents a major upside risk to the inflation outlook. Core inflation remains elevated at tolerance testing levels. Although the continuing pass-through of tax cuts relating to petrol and diesel last November would help to moderate input cost pressures to some extent. The transmission of input cost pressures to selling prices remains muted in view of the continuing slack in demand. Further, as risks from Omicron wane and supply chain pressures moderate, there could be some softening of core inflation. On balance, the inflation projection for 2021-22 is retained at 5.3%, with Q4, that is the current quarter, at 5.7% on account of unfavorable base effects that ease subsequently. In particular, CPI reading for January 22 is expected to move closer to the upper tolerance band, largely due to adverse base effects. Taking all these factors into consideration and on the assumption of a normal monsoon, CPI inflation for 2022-23 is projected at 4.5%. I repeat, CPI inflation for 2022-23 is projected at 4.5%, with Q1 22-23 at 4.9%, Q2 at 5%, Q3 at 4%, and Q4 at 4.2%, with risks broadly balanced. At the current juncture, the conduct of domestic monetary policy is primarily attuned to the evolving inflation and growth dynamics, even as we remain watchful of spillovers from uncertain global developments and divergent monetary policy responses. Our monetary policy would continue to be guided by its primary mandate of price stability over the medium term, while also ensuring a strong and sustained economic recovery. As stated by me earlier on several occasions, our actions will be calibrated and well telegraphed. I would now like to touch upon certain issues relating to financial stability. A strong and well-functioning financial sector fortifies the foundations of growth and development. The Reserve Bank has accorded the highest priority to preserving financial stability by taking quick and decisive steps to ease liquidity constraints, restore market confidence, and prevent contagion to other segments of the financial market. We have been also strengthening the regulatory and supervisory framework for both banking and non-bank financial sectors to proactively identify, assess, and deal with the vulnerabilities. Thus, despite the pandemic-induced bouts of extreme volatility, the Indian financial system has remained resilient and is now in a better position to meet the credit demands as recovery takes hold and investment activity picks up. The balance sheets of scheduled commercial banks are relatively stronger, with higher capital adequacy, reduced NPA, higher provisioning cover, and improved profitability than in the previous years. We have to be, however, watchful of the impact of the pandemic on the banking and the NBFC sectors when the effects of regulatory reliefs and resolution fully work their way through. Banks and other financial entities would be well advised to further strengthen their corporate governance and risk management strategies to build resilience in an increasingly dynamic and uncertain economic environment. They also need to continue the process of capital augmentation and build up appropriate buffers. I would now like to touch on certain issues connected with liquidity and financial market conditions. The pandemic has delivered a once-in-a-century crisis with a health shock morphing into a macroeconomic and financial shock. The RBI undertook a slew of measures to deal with such an exceptional situation. As a consequence, borrowing costs fell to their lowest levels in decades and spreads narrowed across rating cohorts. Record levels of government securities, corporate bonds, and debentures were issued. Corporate entities have been able to deleverage seamlessly and reduced high-cost debt while improving profitability and retained earnings for future capital expenditure. Overall, the financial sector has remained fully functional and has anchored the process of economic recovery. In our assessment, the policy actions of the Reserve Bank have yielded the desired results in a smooth and orderly manner. With these objectives being achieved on an ongoing basis, the Reserve Bank has turned to rebalancing liquidity on a dynamic basis, while maintaining adequate liquidity in support of its accommodative stance. This rebalancing has involved two-sided operations. First, that is on the one side, rebalancing liquidity from overnight fixed rate reverse repo towards 14-day variable rate reverse repo, that is VRRR auction, as the main operation, supported by fine-tuning auctions of varying tenors as envisaged in the revised liquidity management framework of February 2020. And second, that is on the other side, conducting repo auctions of 1 to 3 day maturity to meet transient liquidity mismatches and shortages, as for instance in the recent case of more than expected GST outflows during the third week of January 2022. The key to effective liquidity management is the timing and having a nuanced and nimble-footed approach that responds swiftly to the manner in which liquidity tilts. As a result of RBI's rebalancing operations, the daily average absorption under fixed rate reverse repo has moderated sharply since August 2021, when the rebalancing started. Overall, system liquidity, however, remains in large surplus, though it has moderated over the same period. Reflecting the migration of surplus liquidity from overnight window to longer tenors, the effective reverse repo rate, which is basically the weighted average rate of fixed rate reverse repo and the VRRRs of longer maturity, the effective reverse repo rate increased from 3.37% as at the end of August 2021 to 3.87% as on February 4, 2022, that is last Friday. It may be recalled that while instituting the revised liquidity management framework on 6th of February 2020, the daily fixed rate repo and the daily fixed rate repo and the 4 14-day term repos within a reporting fortnight were withdrawn. In view of the pandemic and the related work from home social distancing protocols, the MSF and the fixed rate reverse repo windows were made operational throughout the day, instead of only at end of the day under normal circumstances. This passive mode of liquidity management worked well throughout pandemic conditions in ensuring adequate provision or absorption of liquidity as warranted by the evolving market conditions. With the progressive return of normalcy, including transient demand for liquidity from the Reserve Bank, it is logical to restore the revised liquidity management framework in order to make it more flexible and agile. Accordingly, 4 decisions have been taken. First, variable rate repo operations. I repeat, variable rate repo operations of varying tenors will henceforth be conducted as and when warranted by the evolving liquidity and financial conditions within the CRR maintenance cycle. Second, variable rate repos, that is VRRR as I would call it, variable rate repos and variable rate reverse repo, that is VRRR of 14-day tenors. So variable rate repo operations and variable rate VRRR auctions of 14 days tenor will operate as the main liquidity management tool based on liquidity conditions and will be conducted to coincide with the CRR maintenance cycle. Third, these main operations will be supported by fine-tuning operations to tide over any unanticipated liquidity changes during the reserve maintenance period, that is during the fortnight ending on the reporting Friday. Auctions of longer maturities will also be conducted as warranted. Fourth, with effect from 1st of March 2022, The fixed rate reverse repo and the MSF operations will be available only during 17:30 hours to 23:59 hours, that is from 5:30 p.m. to 11:59 p.m. on all days, and not during 900 hours to 23:59 hours. So instead of 9 a.m. in the morning till 11:59 p.m. in the night, now it will be available from 5:30 p.m. to 11:59 p.m. in the night, and this will be available on all days. And this is this revised timing of all day operations of this reverse repo and MSF. It was, as you would recall, it was instituted on 30th March in response 30th March of 2020 in response to the pandemic situation. So now that on the liquidity front we are returning to normalcy, we thought it was time to go back to the status quo ante. Market participants are advised to shift balances out of the fixed rate reverse repo into VRR auctions, VRR auctions, and avail the automated sweep in and sweep out facility, that is ASISO facility, in the eKuber portal for operational convenience. This sweep in and sweep out makes the entire process of, if you want to utilize the MSF facility or you want to utilize the reverse repo, fixed rate reverse repo facility at 11:59 or after 11 o'clock in the night, then the system is automated, and we have put in place what is called the ASISO facility. The details are given as a footnote in my statement. For those who would like to have a look at it, may please have a look. In the forex market, the Indian rupee has shown resilience in the face of global spillovers, even relative to the EME peers. India's external sector sustainability is anchored by high foreign exchange reserve buffers, as a modest level of current account deficit. Let me put it again. I think there was some miscommunication. India's external sector sustainability is anchored by high foreign exchange reserve buffers and a modest level of current account deficit, CAD. In first half of 21-22, the current account deficit was 0.2% of GDP, underpinned by robust exports of goods and services. The merchandise trade deficit has widened in recent months, partly due to elevated crude oil prices and rise in non-oil imports in line with the domestic economic recovery. Buoyant services exports led by IT services with strong prospects for going forward are, however, likely to keep the current account deficit contained well below 2% of GDP during 2021-22, that is during the current financial year. Moreover, foreign direct investment flows remain strong, which along with other forms of capital inflows are expected to comfortably finance this modest level of current account deficit. In a global environment rendered highly volatile and uncertain by diverging monetary policy actions and monetary policy stances by various central banks, geopolitical tensions, elevated crude oil prices, and persistent supply bottlenecks, emerging economies are vulnerable to destabilizing global spillovers on an ongoing basis. Thus, policymakers face daunting challenges even as recovery from the pandemic remains incomplete. On its part, the Reserve Bank has been and will continue to insulate the domestic economy and financial markets from these spillovers. Further, while the RBI will continue to focus on smooth completion of the government borrowing program, market participants also have a stake in orderly evolution of financial conditions and the yield curve. It is expected that market participants will engage responsibly and contribute to cooperative outcomes that benefit all. Let me now proceed and make a few additional measures which we have decided, and let me now go and announce some more additional measures. The first one relates to extension of the on-tap liquidity facility for emergency health services and contact intensive services. On-tap liquidity facilities of rupees 50,000 crore and 15,000 crore for emergency health services and contact intensive service sectors respectively were announced in May and June 2021 during the second wave of the pandemic. Banks were given certain incentives for lending under the two schemes. On account of the continued uncertainties brought on by the third wave, the two schemes are now being extended from 31st March to 30th June 2022. Next one relates to the voluntary retention route enhancement of limits. The voluntary retention route scheme, that is the VRR scheme, it's different from the VRR which I referred to earlier that related to the repo operations. So this is the voluntary retention route scheme was introduced in March 2019 to facilitate long-term investment by foreign portfolio investors, that is FPIs, in debt securities issued by the government and the corporates. The response to this scheme has been very encouraging. It is therefore proposed to enhance the limit for investments under this scheme by rupees 1 lakh crore from rupees 1.5 lakh crore at present to 2.5 lakh crore with effect from 1st of April 2022. This will provide access to additional sources of capital for both domestic debt market including the government securities. Next announcement is as follows. The guidelines for credit default swaps, that is CDS, initially issued in 2013 were reviewed and draft guidelines were issued in February 2021 for public comments. Taking into account the feedback received, the final CDS directions are being issued today. These guidelines will facilitate development of a credit derivatives market and deepen the corporate bond market in India. The next announcement relates to permission to banks to deal in foreign currency settled rupee derivative markets. Banks in India have already been permitted to offer rupee interest rate derivatives such as overnight indexed swaps, that is OIS, to non-residents. Now it has been decided to allow banks in India to undertake transactions in the offshore foreign currency settled overnight indexed swaps, that is FCS OIS market, with non-residents and other market makers. This will reduce segmentation between onshore and offshore markets, enable more efficient price discovery, and further deepen the interest rate derivatives market in India. The next announcement is very important for with regard to digital payments and with regard to government implementation of government schemes. And this relates to enhancement of the cap under the e-rupee, which are basically prepaid digital vouchers using the UPI. The e-rupee prepaid digital voucher developed by the NPCI was launched in August 2021. The single-use cashless payment voucher has a cap of rupees 10,000 at present. It is now proposed to increase the cap of e-rupee vouchers issued by the central government as also by the state governments from rupees 10,000 to rupees 1 lakh per voucher and permit such e-rupee vouchers to be used more than once until the amount of the voucher is completely redeemed. This will further facilitate the delivery of various government schemes to the beneficiaries more efficiently. The next announcement relates to enabling better infrastructure for trades settlements. The Trades Receivable Discounting System, that is TRADES, facilitates the financing of trade receivables of micro, small and medium enterprises, that is MSMEs. Transactions in trades are settled through the National Automated Clearing House System, that is NAC system. Keeping in view the requests received from the stakeholders and to further enhance the ease of financing the growing liquidity requirements of the MSMEs, it is proposed to increase the NAC mandate limit from rupees 1 crore at present to rupees 3 crore for trades related settlements. The next announcement, and this is the last announcement before I conclude, I request your patience. This relates to issuance of master direction for IT outsourcing and master direction on information technology related to governance, risk management, etc. Extensive outsourcing of critical IT services, leveraging of technology by regulated entities of the Reserve Bank, and increasing use of digital channels by customers expose the regulated entities to significant financial, operational, and reputational risks. A need was therefore felt to review and consolidate and also streamline the existing guidelines. Accordingly, 2 draft directions will be issued for comments of stakeholders and members of the public. The first one relates to Reserve Bank of India IT outsourcing directions 2022. The second one relates to Reserve Bank of India information technology governance, risk, controls and assurance practices directions 2022. Let me now conclude. We are living in a world of Knightian uncertainty. In the absence of determinate knowledge about the next mutation of COVID-19. The ability to forecast the future course of the economy is so contingent on the evolution of the virus that one prognosis is as good or as bad as the other and as ephemeral. If the last 2 years of living with the virus have taught us anything, it is to remain humble but grounded in self-belief, never losing confidence and optimism. As the great Lata Mangeshkar, whom we lost recently, sang in her immortal voice, "Aaj fir jeene ki tamanna hai." Together with the spirit behind the next line of this beautiful song, she has conveyed an eternal message of optimism. We in the Reserve Bank have remained steadfast in our commitment to safeguard trust and confidence in the domestic financial system as we rebuild the foundations of strong and sustainable growth with macroeconomic stability. This has been our anchor in the ocean of uncertainty. We are inspired by Mahatma Gandhi's spirit of constant striving amidst challenges, and I quote, "Satisfaction lies in the effort." I repeat, satisfaction lies in the effort. Full effort is full victory. Thank you. Stay well, stay safe. Namaskar.